Welcome back to Better Conversations, the Life and Money podcast. I'm Patrice.
And I'm Eric.
And today's conversation might surprise some people because we're not going to spend much time talking about investments. We're not talking about the hottest stock, the latest economic prediction, or even the newest tax strategy. Instead, we're talking about 5 retirement decisions that may matter more than investment returns themselves.
That's definitely not an exaggeration, Patrice. I've spent years, decades, helping retirees maximize their retirement and the retirement income strategy. And what I find so often is that retirees kind of over-optimize. They're constantly trying to optimize for very strategic, tactical details of investment and retirement planning. But they often overlook some fundamental issues that drive the plan. And these aren't necessarily like mistakes. They're not making mistakes. They're just, and these are not really about money, but they're just assumptions that drive the full success of the plan. Think of it this way. To me, it's kind of like building a house. Oftentimes people spend so much time overanalyzing the appliances in the kitchen, for example, that they want to purchase, but they don't spend enough time on the layout of the kitchen. And so these decisions are more about creating the right blueprint than about the materials that are going into the house, the stocks and the bonds and so forth.
So basically, they're not really mistakes. It's just that they're decisions or people are making, and they may not be very conscious about them.
Yeah, and they're not necessarily about the money. They're about goals, values, family lifestyle. It's how you want your retirement to look and feel that oftentimes gets overlooked.
Okay, well, let's start with the first one because we've got 5 to get through. What is the most important retirement planning conversation that you say people really aren't having?
The big decision that is often overlooked is this. Do you want to die with a full tank of gas or arrive at the end with an intentionally empty tank? Okay, so think about this. Think about money like fuel in your car. Our goal isn't to hoard gasoline, is it? We need enough. We don't want to run out. We want enough to where we want to go. And your money's kind of the same thing. And this decision of whether you want to die with a full tank or intentionally empty, it drives everything, Patrice. It drives your investment strategy. It drives the withdrawal strategy. It drives spending, taxes, estate planning. It's really key, and most people don't think of it in any kind of context. That's
amazing. It really, just in this moment right now, it's altered the way I'm starting to think about something. I mean, do I want to leave anything to people, or do I want to have fun with it all?
Yeah. Most people tell advisors they want to maximize their income in retirement, but what they're also really saying is they want to preserve every dollar of principal.
Yeah.
And those are two very, very different objectives. And so great retirement planning starts with defining success. It really does start with defining what does the end look like, and then working backwards and keeping the end in mind.
And I would doubt many people think of it that way. You are usually planning ahead, not looking ahead and then planning backward.
Right. But again, that decision really affects what rate of return you need to earn. If you want to keep all your principal intact, you're going to need to have a much higher rate of return than if you were willing to spend your principal down.
Mm-hmm.
And likewise, that affects taxes. It affects the risk in your portfolio. So again, it's a very big decision that is often overlooked.
So before we even talk about returns, let's define the destination. How do we decide where we want to be?
What does success look like? How much do you want to have left in the tank? I find most people really still can't define that very well when talking about it. And so what do we usually set on with clients is defining what might be a safety net. We call it the safety net, which is, okay, what's a minimum amount of money you want to have left in your portfolio at age 90 or some life expectancy, some age that we agree on. I think of it this way. When I travel, I generally don't want my gas tank to get below a third of a tank on a long road trip. I want to make sure I have enough reserve. And that's a starting point with clients of maybe deciding, hey, let's make sure we always have a third of a tank or a third of our money left at the end, so we never really have to stress too much.
Seems fair. All right, well then let's move on to Social Security, because this is a focus, I think, of just about everybody. And there is no one answer, right?
Social Security consumes so much time and energy for people in retirement planning, and they're overlooking a significant issue, which Social Security tends to be about maximizing my income. So the big question that's often missing is, are you trying to maximize your income or maximize your wealth?
Now, wait a minute. Everybody's told you want more, you got to wait until you're 70.
Right. That's the boilerplate rule of thumb answer to maximize your income, delay it, take it age 70. That's about maximizing your income. But what we find very frequently is some people want to maximize their portfolio. In other words, if you take Social Security at 70, many people have to start drawing out of their portfolio earlier. And that's a decision, but there's a trade-off. Generally, many times, the sooner you take out of your portfolio, the less you might have later in life. And so some people choose to maximize their wealth, maximize their portfolio, and they'll choose to take Social Security even at age 62 early, take the haircut, the reduced amount, but it prevents a withdrawal from their portfolio, thus allowing it to compound longer and to grow potentially bigger.
So how do you help people understand the trade-off here, the difference? Do you show them different scenarios?
It is personal. Absolutely. It depends on your goals, your income taxes, your health, the size of your portfolio, your life expectancy, and family circumstances. So there is no easy answer. And of course, Social Security would be simplistic and easy if we all knew when we were going to die, which we don't. And so there's always an assumption that maybe we live to life expectancy or some other age that we agree on with the client. But that's the starting point.
All right, very good. But again, Social Security, there is no one answer for everybody.
There's no one answer.
Yeah.
There's no one answer. But there is a question of whether you want to maximize the income or your net worth.
All right. Long-term care. Now, this is something that until a couple of years ago, you really didn't hear too much about, but it's become, you hear it all the time now.
Yeah, for retirees, this boogeyman of a risk is always out there of what if we need extended care, which could be assisted living, it could be home health, it could be in a skilled nursing facility, but everybody is kind of aware of how expensive it can be. And it's concerning to retirees to have this potential risk looming over them. Most all of the conversation tends to be around, should we buy insurance or plan to quote unquote self-insure or pay out of pocket? And it all becomes a financial transaction decision. And I think that's important for sure, but it overlooks a bigger issue or a bigger question.
Well, what would that be?
The big issue are, what are the consequences if I need care? What are the consequences? What happens to my family if I need extended care? That question's not about money. That becomes a conversation about family risk, relationship risk, the burden on caregivers. And so oftentimes that leads to a better conversation, pun intended, which is purchasing an insurance policy for extended care, even if you can afford to pay for it yourself, is oftentimes just a gift to your family. The reason I say that is because those that have been caregivers can acutely understand how difficult it can be being a caregiver, whether it's your spouse or a sibling, a child. It can really disrupt families. It can affect people's health. It's hard. It can affect marriages, work-life balance, personal family situations, especially if people are remote or from any kind of distance. And so buying an insurance policy is oftentimes just a gift to your family to relieve a burden, because once people have an insurance policy, they tend to put in a claim. They don't want to let that policy go unused. And all of a sudden, then you've given a gift to your family, which is a permission to take a break from being a caregiver and have some home health care come in, or get some care in a facility to relieve the stress and the real burden that caregivers take on. So it moves it from the financial conversation. Many of our clients can self-insure and pay for care out of pocket, but they choose to buy a policy for this reason. They know the burden it might put on their family, and they want to give their family a backdoor or a relief valve, so to speak, and be able to get some professional help. Because what many caregivers do, Patrice, is they tend to sacrifice themselves, whether it's out of guilt or burden, or sometimes they just try to maximize their inheritance, frankly, and not spend the money. But having a policy in place can be just a real gift. So it's a question that's not usually talked about, answered in this conversation of should we buy insurance or not.
That is so true. And yet the expense of a person's well-being, how do you measure that against the expense of care? It's a totally different approach to the conversation. I appreciate that very much.
Well, listen, I don't like insurance. Nobody likes to pay for insurance. It's just what are the consequences? And of course, if you never need it, that's feels like a waste, but there's a value in having some peace of mind and understanding what the burdens could be in your family.
And yet when you're thinking about long-term insurance, usually you might be a little bit younger. You're not facing imminent disabilities. So it's probably very hard to think about it from the family point of view. You are thinking about it from the monetary point of view. How do you help people see that?
Well, just to think about it, for example, I'm 58. I'm right now in real time considering a policy because I've seen my wife care for her mother and how much she is involved with her mom. And her mom's independent still, but there's still just a lot going on. And I can quickly realize with my wife, Terry, that she may be inclined to give up and sacrifice her life to take care of me if needed. And I really want her to spend her time with my two daughters and living her life and seeing her family and doing things if I ever needed care. And so for those reasons, I'm considering a policy, even though it's not about the money. It's about, I don't want Terry to be feeling like obligated. And I think if I had a policy myself, that would give her some freedom to put a claim in and still live her life.
All right. And how about a policy for her?
Yeah. I mean, that's a fair question. I tend to think that I can handle it and I'll take care of it.
Mm-hmm.
But I'm more of we talked in a different episode about a commitment money mind, which I'm more worried about her and her well-being. And, but to be fair, we should consider it for each other probably.
All right. The income myth, when I retire, I'm not going to need as much money. 70 to 80% of my income, right? That's all I'm going to need.
You hear that everywhere. It kind of drives me crazy. Rules of thumb drive me nuts. There's something about that where so many places tell you only need 70 to 80% of your pre-retirement income when you retire. And that's just odd to me because think about it this way, Patrice, if you retired on a Friday, why would you want to reduce your lifestyle 20 or 30% on Monday? Why would you need 20 or 30% less money on Monday over the weekend?
Absolutely. And how many people, what's the big thing when you retire? You want to travel, right? What does that mean? Money.
So certainly there's some expenses that can decline immediately upon retirement. Maybe there's some retirement savings and different things. But generally what we find is clients need and want 100% of their pre-retirement lifestyle because, as you mentioned, they want to travel more. There's things they want to do with their grandkids or you name it. And they don't really want to walk into a big reduction in lifestyle. That said, we trick ourselves sometimes in thinking we only need less because we want to be retired. And we underestimate what that lifestyle really is. And so underestimating your true retirement expense creates significant retirement planning problems later on in the years ahead. So being realistic about it is important.
Who came up with 70 to 80%?
I don't know.
Obviously, they didn't retire.
But it's repeated everywhere. Yeah.
Oh, well.
The bigger issue is probably most people that we see can't really identify what their lifestyle expense is.
True.
And that's probably the bigger thing, is not budgeting, but just becoming really aware of what are your fixed expenses that you can't change or that won't change. And then really, what does discretionary spending look like? And again, I'm not advocating budgeting because nobody likes budgeting and it doesn't work, but
Bad word, Eric. Budget.
becoming aware of where your money's going and what you're going to want to maintain in retirement is really key, that most people don't have a good handle on.
You know, when you come right down to it, too, you may find something that you really enjoy doing, too, once you're retired, and it could cost you money.
Yeah.
Like golf.
Yeah, absolutely. I'm in South Dakota. Lots of people have horses and things that are
Expensive.
significant expenses. Yeah.
They are.
Yeah.
Now, if you're in an affluent household, I guess you really wouldn't worry too much about the 70 to 80%.
Yeah, probably. Again, many affluent households, that's my point. Many affluent households, they really don't know what their spending is because they're not paycheck to paycheck. And so really dialing in on what that expense is. So even affluent households will underestimate what it really costs for them to be retired and live and maintain their lifestyle.
All right, well, let's finish up with what may be the most overlooked concept of all.
Speaking of lifestyle, many people have the wrong focus. They're focused in on how much retirement income I can have today. And the question that's overlooked is, do you have any overall strategy to double, if not triple, your retirement income? So it's not about, retirement planning is not about how much income you can have today. It's about how do you get growth of that income. Why?
Mm-hmm.
The cost of living is sneaky. Inflation.
Oh, yeah.
Patrice, we've seen inflation in real time the last few years, where you go to the grocery store and you absolutely see how much a pound of apples has gone up in price. But generally, inflation is what I call like high blood pressure. You don't see it and you don't feel it on a day-to-day basis. So to give you an example, this is just simplistic in real life. A 62-year-old couple has about a 50% probability that one or if not both will live 30 years. It's a long time.
Mm-hmm.
If we go back in this simplistic example to 1995 and 1996, what do you think a cost of a U.S. first-class postage stamp was, Patrice? Do you have any idea?
You know, now they've got the forever stamp, so I have no idea what they are now, much less what they were.
32 cents.
32 cents.
Okay. On July 12th, 2026, the cost is going up to 82 cents.
Wow.
Okay. So what does that mean? A simplistic postage stamp. We may not use as many of them anymore, but the point is, everything that you're going to buy for the rest of your life, you have to assume is going to go up in price, always has, and probably always will. So going from 32 cents in a postage stamp in the last 30 years to 82 cents now is 3.08% inflation. You really don't know. So on $100, in my lifetime, I'm 58, born in 1968, the inflation average has been 4%. So that means the cost of living doubles every 18 years if history is any guide. Retirees in general, on average, could live 18 years, if not much longer. Hence the postage stamp example that's gone up 2.5 times in 30 years. So again, the question is, what's your strategy to double or triple your income over the next couple of decades? And that is a very simple answer that we're not going to get into in this episode, but it's very tricky and not easy. So it's simple, but not easy. But your retirement plan has to create this growing income, because living on a fixed income in a rising cost world gets pretty uncomfortable after a few years of retirement. But interest rates on your bonds and CDs and bank savings accounts and so forth cannot be expected to go up every year the rest of your life. In other words, in 1968, when I was born, the interest rate on United States Treasury bonds was 4.58%. And when I looked this morning at this recording, the interest rate on a 10-year U.S. Treasury bond was 4.45%. I'd call it the same, but it's actually a little bit lower.
That's not good.
So you can't expect interest rates to go up every the rest of your life, but the cost of living will. And that's a strategy decision that is very important in the overall scheme of things.
Right. Well, you have really turned around the thinking on several important questions here, Eric. I appreciate the conversation that none of these topics are really about optimizing investments or taxes here.
Those ingredients, those materials for your financial house are extraordinarily important. I'm not minimizing them. But if you don't get the blueprint right, you're not necessarily going to be happy with the house.
Right. All right. So let's just recap the 5 decisions we talked about. First, how much do you want left at the end of your life? Are you going to spend it all or are you going to leave it all? Second, Social Security. Do you maximize income or maximize overall wealth? Third, how do you want to manage the risk and burden of long-term care? Fourth, what lifestyle do you actually want to maintain in retirement? And then fifth, how do you make your income grow and not just have a fixed level of income? I get them all?
Yeah, I think that's it, 100%. It's not about picking the best investment. It's about asking better questions and just getting all the assumptions really dialed in correctly.
And I suppose we could say that's what sophisticated retirement planning really looks like, right?
Yep. Not about chasing returns. It's just about getting the strategy right that allows you to live the life you actually want to live.
All right. That's great. Well, listeners, thanks for joining us for another episode of Better Conversations, the Life and Money podcast. If this conversation resonated with you, share it with someone who's preparing for retirement or who may already be navigating it. And as always, thanks for listening. Thank you for listening to Better Conversations, the Life and Money podcast with Eric Lee from Purple Wealth. If this episode sparked something for you, follow the show so you never miss a conversation. You can learn more at www.purplewealth.com or reach out directly. We'd love to hear your thoughts. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Purple Wealth is a separate entity from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Any guests and their companies are not affiliated with or endorsed by LPL Financial or Purple Wealth. Individual tax or legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.